Now, this next subject is one that many of us rather not talk about, death. And so we put off discussions about legacy planning. But to avoid these discussions or to delay making decisions could hurt your loved ones and even cause family discord should an unexpected demise occur. In the second part of our series, The Wealth Outlook, Cho Keng-yut looks at the finer aspects of legacy planning.
Upon death, we leave behind a legacy. The kind of legacy you leave behind needs to be determined by you before you die, or it will be others who will decide for you. If you want to be the one making the decisions, then you have to do legacy planning. And increasingly, it's not just about passing on your wealth and personal assets. Legacy has taken on a broader meaning.
It is not about dollar and cents anymore. It's also about your identity that you want to leave behind. So what do you stand for as an individual?
Many now want to be associated with social causes, so they put these into their legacy plans.
There's a greater level of awareness now. Besides leaving a legacy for their loved ones, their children, they are also thinking about how they can actually contribute to different charities, how they can contribute to the environment, how they can actually contribute in a small way towards these causes.
The family culture and values are also taking on greater importance in legacy planning.
Is about what do you want to stand for as a family. Some of the examples that we've seen is people buying cultural artifacts which resonates with their family values. It could be doing something back home for your ancestral hometowns or villages.
And if you have a business, it should also form part of your legacy plan.
I've come across cases where business owners actually failed to consider this aspect, and that resulted in the businesses being affected.
Mr. Tan says business succession planning is gaining momentum in Singapore. Business succession planning is not just about deciding who your successor is. It's also about ensuring your successor is able to take over from you.
That should start on during the lifetime by having a proper communication with their family members, deciding who your successor would be, and then ensuring that they have the right skills to take on the business. If there is a mindset for the younger generation to look at a different chapter to the business, it could be by virtue of a subdivision, it could be a business within the business itself, but yes, in some cases it could be a completely new venture as well. But that will only happen once the discussion happens between the generation which is passing on to the new generation.
The business owner should also discuss his intentions with shareholders and other stakeholders of the company.
That also has to take into account whether the existing shareholders or directors will be happy to have the next of kin on board.
And once you've decided what legacy you want to leave behind, a will is a good starting point to put your intentions down in black and white.
In a survey we've done, only about 18% of respondents from Singapore have created a will. If you don't have a will, the probate process can be long, it can be time-consuming, it can lead to family feuds.
Your will should state clearly who are the beneficiaries of your personal wealth and business assets. You can also appoint nominees for your insurance policies to ensure the insurance proceeds go to them.
Insurance, they can do a thing called nomination. So sometimes they will put inside the nomination, example 10% to this charity organization. If something happened to the person pass away, the payout 10% will go to the charity organization. So that's why they want to give back, or they allocate their assets to the family member, to the charity organization, or to a pet house or a nursing home.
But how should you go about dividing your personal wealth among your beneficiaries?
Let's take an example of a business owner who has $5 million worth of business, you have property worth $3 million, and you have financial assets worth $2 million. Now, it's not easy to divide this between your family members because these are different assets or different value.
In the above example, let's say beneficiary A gets the $5 million business and beneficiary B gets the property worth $3 million, and beneficiary C gets financial assets worth $2 million. To ensure all three get the same amount of inheritance, you can use a strategy called estate equalization.
The tool used for estate equalization is insurance. Insurance creates a benefit coming out of the sum assured, and that can be an instant liquidity which can be used to create a balance between the different asset classes for the family members.
You buy life insurance that will pay out $2 million to beneficiary B and $3 million to beneficiary C. In this way, all your beneficiaries get $5 million upon your demise. Even before you think about distributing your assets, it's important to make sure that you've settled your liabilities and debts. Your liabilities could include your home mortgage, credit card loans, and car loans.
Many Singaporeans have mortgages, right? But many of them think that, they have 20, 30 years tenure to pay the installments. Many of them do not think, what if they were to pass away and there is still an outstanding mortgage left? Would the family members be able to settle these mortgages in lump sum? If the family members are not able to settle the outstanding mortgages in lump sum, then the banks may actually come in and repossess the property.
To protect your loved ones, you can use term insurance to cover these debts.
With the liability, we will advise the clients to take out, example, they got mortgage loan, we'll make sure they have mortgage insurance. So all this will come in handy. If they got credit card debts or they got car loans, then if they want to use a small instrument, they can use term insurance to boost up the coverage to cover all this liability.
Income tax payable by you can also become a liability to your loved ones upon your demise.
Wherever we work this year, if a person were to pass on, whatever salary that they earn this year is still subject to income tax. So next year, the IRAS will actually send letters to the family member to clear the tax.
And if you have a business, don't ignore your business liabilities.
It need not be just debt. It could be legal litigations. It could be losses in business. So one has to make sure that you're adequately covered when it comes to any form of liabilities, using insurance and other tools to make sure that the debt or the liability is not passed on to the family after you're gone.
You can have the most comprehensive legacy plan in place, but your plan will come undone if you don't even have enough to look after yourself when you're alive. You'll need sufficient funds for your retirement. You also need to have health insurance to cover your medical expenses.